Hi, this is Dwayne, CFRN. It is Sunday afternoon, 4:25 p.m. Pacific Time. Today's the 11th day of August, 2013. And this is just a Sunday afternoon Globex session with everyone who wandered in off the street. We attempted to do a Google Hangout. It was an epic fail. So I just sent out an email. I launched a GoToWebinar because that's something I know how to do. I'll figure out how to do the Hangouts because it's supposed to be very cool. But point is, we're now here and I now have the recorder going. And that's important because those who can't or weren't able to make it, I'll get all these angry emails. How could you have a meeting and not invite me? Sorry. It was almost impromptu. Ken asked, are you saying hourly closes above certain levels or on a close above on a 4-tick? Mark says, oh, the reason that Google asked you for, Mark, a date of birth is because they want to make sure you're over the age of 13. Now, I understand everybody is concerned with Google and Big Brother and I Spy, and I'm sure you didn't give them your real birth date anyway, but so that's the reason. It has to do with the 13-year-old thing. I was setting up an email address for my daughter the other day, and me, just trying to be an honest guy, I gave them her actual birth date. Shame on me, because now she can't get an email address. Unless I lie and give her an alias, which I guess we'll just get an email address somewhere else. But, anyway, that's why they want to know your date of birth. Okay, so Ken, now your question, that's a great question. Are you saying hourly closes above certain levels or on a close above on a 4-tick? That's an excellent question. It depends upon the time frame that you're looking at. Okay? See, if we're looking at hourly candles, inside of these larger hourly candles, in fact, let's do this because this is a great big green candle. All right, this is August the 9th at 6 a.m. Pacific time. Let's go look at that on a 1-minute chart, just so you get an idea of what I'm talking about. Let's go 1 minute. I got to scale this thing out. It's not used to doing a 1 minute. Okay. Now that day, again, was August the 9th at 6 a.m. August the 9th, 6 a.m. Here's August the 9th. All we've got to do is walk our way back to 6 a.m. Okay. Alright. This price, this swing high right here is 91 and a half. Okay. Let's just write that down for a moment. 1691 and a half. Let's go back to our hourly and find 1691 and a half. There's 1691. So 91 and a half is going to be right there, roughly, in this green candle. Okay? So your question, when I'm talking about a close above or below, is it a 4-tick, is it on an hourly? It depends on the time frame you're looking at. And now I'm a firm believer in multiple time frames, and anything I ever teach you is going to be based on the observation of multiple time frames. Whether you use my time frames, which are predominantly the hour and the 4-tick range, you may like a 30-minute and a 5-minute. You've got to have a way of balancing out, and the larger time frame is always going to carry more weight. That's going to be the dominant time frame, the larger time frame. Now we can go up to a daily. In fact, we were on a daily. I'll show you something on the. Remind me in a minute, and I'll show you the dollar chart on a daily. I'll show you. In fact, let's finish this up. Let me make a note to myself. Dollar daily chart. I'll go to that in a minute. So see how a close above 1651.50? You see how that's important to us on this 5-minute chart? But on the hourly, we don't see any real relevance at that price, because we're dealing to find a point of reference comparable, we have to go to this candle here, okay, which isn't too far off. Again, and a lot of that has to do with these ranges being so congested and so constricted, okay. So 1692. Now, if I'm balancing these two time frames off of each other, I can tell that I want to be long up above that area. Right there. Okay. Now, this is a 5-minute chart, not a 4-tick range, but everything applies here that applies on the 4-tick range. The reason we use a 4-tick range, that's sort of an unusual time frame. We use that because it allows, after much years of experimentation, work, research, whatever you want to call it, horsing around, it allows us to consistently apply 8 ticks of risk to every trade. Doesn't matter if it's crude or gold or the S&P or the NASDAQ or the Russell. By using the 4-tick range chart to execute our trades on intraday, we never have to risk more than 8 ticks. But because the markets are fractal in nature, and that's sort of a there's a long explanation there, but if you just Google it, in fact, if you Google CFRN fractal, I wrote an article some time back regarding that, where I try to go into a bit of an explanation as to what that is and how it is. But anything that works, and this is something, to take this away today, anything that happens on a 1-minute chart or shows up on a 1-minute chart or can be done on a 1-minute chart can also be seen, done, used on an hourly, on a daily, on a weekly, unless it's something that doesn't embody the underlying rhythm of the market. And that's what our work does, is it embodies the underlying rhythm of the market. And here's an example. We have a bullish cross. That's step 1 for our trade. After step 1, we need price to pull away from the green line, okay? Then we need price to pull back. Once it pulls back, we then need to find out if we have bullish divergence. How do we tell that? We go to the lower panel and we draw an arrow towards the red and blue line. Okay? Up here, the red and blue lines called the CFMA1. That is our primary indicator, the backbone of our indicator set, if you will. In the lower panel, it looks the same, but the mathematical formulas behind it are much different. Down there, we call it the cycle. We're not the most creative of guys when it comes to naming stuff, but you gotta call it something, right? So, you draw an arrow pointing at the cycle. If the arrow's pointing up, then it's bullish divergence. If the arrow's pointing down, it's bearish divergence. Like here, this is bearish divergence. Okay? All right. So, bullish cross, price. Now, when that happens right there, now this doesn't matter if this is a 1-minute, a 5-minute, a 10-minute, it doesn't matter. Our daily, when you have this little cross right here. There's a shift in power. The bears were in control. The balance of power was in the hands of the sellers all the way down, even through this retracement. But here, right there, it shifts. Buyers are now in control. There's no way I want to short a market when the buyers are in control. I want to go with the flow. Okay? There's a bit of me that's a contrarian and cantankerous and all kinds of stuff. But I've learned, painfully so, that the market is much bigger than I am. I can't outsmart it, outrun it, or outlast it. Okay? The market always wins. So, I think all of us at some point early in our trading career go, man, I'm going to kill the market today. I'm going to tear it up. I mean, it's a common term. You hear this fund manager, he beat the market by, such and such a percentage. All right? That's faulty thinking. You don't want the market to be your enemy, your adversary. Okay? You want the market to be your business partner. I wake up every morning, good morning. Can I get you some coffee? How you doing? What sort of a mood are you in today, Mr. Market? Are you bullish and bouncy? Are you boring and bearish? I mean, what is it? I want to know, and whatever the market is up to, that's what I'm up to. I've got just as many opinions as anybody else, but I leave them at the door when I come in to sit down and go to work to trade. Okay? I want to take the temperature of the market, whatever the market's up to. See, all I need to do is latch onto the market's coattails for 2 points. That's it. If I can latch onto the market's coattails for 2 points, I'm done. That's my day. I don't need anything else. These tweets I put out that go for 5 and 7 and 10 point, whatever they go, that's wonderful. That's fantastic. I'm glad that people, find them interesting and put them to good use. But for me, and I'm not saying I don't ever stay in a trade longer than 2 points, but that is my bread and butter. That's the thing that I know without any question every morning that God gives me a new day to roll over and put my feet on the floor. I can go and sit down in front of my computer. I can peruse the various markets, or I can just stare at the S&P. And somewhere over the course of the day, the ups and the downs and the sideways, the market is going to make an opportunity available where I can take a couple points out of it. Okay? I don't have to fight, fuss, fidget, argue. I know what my opportunity looks like, and when it arrives, take advantage of it, and I'm done. Okay, let me get too sidetracked here. So the bulls take control. Price pulls away, price pulls back. We check. We've got bullish divergence. Fair enough. Now, since the cycle did not change color, since it stayed blue on this move, we don't need to draw a trend line. Many of you who've been in the live trading room, or if you're already partners, you know that we come along and we draw this trend line. We need an up close above the trend line in order to enter the trade on the long side. Well, because the cycle didn't change color on the candle that pulled back right here, this one, that's the one. That's the one we're working off of right there. Okay? Stayed blue, so we don't need a trend line. All we need is an up close. And this is an instance where we not only had it pull back, touch the green line, the BBC as we call it, bull bear cross line, that's all it means, bull bear cross. If it's below the green line, bears are in control. Price is above the green line, the bulls are in control. All right, so we would be buying. This is our signal. We get our signal here and our triggers here. The open of this candle. The open of this candle is 1689 and a quarter. 1689 and a quarter. 1689 and a quarter. Okay. right there. And then the ensuing swing high is 1692 and a quarter. 1692 and a quarter. 1692 and a quarter. Now, people would go, well, gee, that's more than 2 points. Is it? Yeah. What is that, 3 points? Why wouldn't you stay in it for 3 points? Well, you can. Now let me remind you, we don't use this is a 5-minute chart. I was just showing you the market's fractal in nature thing. We can use this on any time frame, but the reason we use the 4-tick range is because it allows us to limit our risk to just 8 ticks on every trade and on every market. Now let me show you this. Somebody had asked a question the other day about the dollar, and it just so happened that we had just finished talking about the dollar on the daily chart. And let's see, at DX. Okay, look right here. Shift in power, okay? This is the dollar. This is a daily chart now, not 4-tick range, not 5 minutes. Bears are in control. Right there. We know to the tick who's in control and at what price the shift is made. All right? And every CFRN partner knows when we take a 4-tick range trade, there's not a bunch of guys all over the world from Brooklyn to Bangladesh wondering what price they should be getting into the market at. Every partner knows the entry price to the tick. They all know that it's a long trade. They've all gone through 1, 2, 3, 4, 5, all 5 steps. And if you're trading, if you haven't already gotten your points for the day, everybody is getting in at exactly the same price. There's no question. There's no ambiguity. It's not nebulous. I spent a lot of time chasing that thing. And I got to tell you, that dog don't hunt. The old, well, this is like a pretty good neighborhood to, maybe, how does that go? Let's see if we can get a few nibbles. Yeah, and then the next thing you know, the guy's crowing about how he just took 12 points out of the market and trying to make you feel a little silly because you didn't. Well, that's just ridiculous, okay? You need a methodology where there's never any question about if you should be in or not be in and at what price, okay? Crystal clear. Anyway, on this particular trade with the dollar daily, it's the same thing because it's fractal. Bullish cross, price pulls away, price pulls back. Well, the next step is we have to check for bullish divergence. Do we have it? So you just follow, wait, that's the wrong one, this one. See, the candle right where it pulls back, the one that touches. You follow it down. Now see how in this instance the cycle line has turned red. It's no longer blue. What that means is, now number one, we only want to trade high probability setups, okay? We've lost a little bit of our high probability edge down here when that cycle, on a bullish trade, when the cycle turns red, we've lost a little bit. So we need up here, we need a little something to put that back in. Okay, we need to return the edge. And this will save you so many times from getting into trades that you don't want to be in. Because the cycle changed color, we're going to now use our trend line tool, and we're going to go to the swing high, and we're going to draw it right back down to the green line, right across the tops of these candles. In fact, that's how this even came about the other day. Someone at the end of the show and the after show, they said, "Hey, Dwayne, I'm really having a difficult time figuring out where to draw the trend lines. Could you help me with that?" And I think that person might be in here today. Was that you, Ken? Yeah, it was Ken. Okay, good. All right. So, did that help you, Ken? Are you good now with your trend lines? Beautiful. Beautiful. Okay, I'm really glad. All right, so guys, up close. This candle opens at 81.64 and price runs up to 84.59. If we were to trade this chart, we couldn't do it with 8 ticks of risk. Could we trade it? Absolutely. Now here's another good example over here. Down here we have a bearish cross. Price pulls away, price pulls back. Okay. Oh, hang on, get ahead of myself. All right, on the candle that pulls back right there, the cycle changes from red to blue. That means we got to have a trend line. We have bearish divergence, but because of the change in color, we have to draw a trend line. So we'll go right across the bottom of these candles. Okay. Bearish cross. Price pulls away. Price pulls back. We check for bearish divergence. We have it. The cycle line has changed color. So we have to draw a trend line. And now we need a down close below the trend line. Well, we don't get one. Not only do we not get a down close below the trend line, this little black line here, the step line, it works its way up into the green line, okay, the BVC, and that disqualifies the trade. There's no longer a trade there because of that. It's disqualified. No trade. The slingshot is very good at not only putting you into a high probability setup, but it's also very good at keeping you out of trades that have lost their edge for whatever reason. Had we simply sold here, that would have just led to being stopped out. But the way this comes together, we were saved the agony of having to deal with that. Okay? Alright. So, over here, if we bought, just for argument's sake, if we had bought the up close, which when you say you need an up close above the trend line, what you're really talking about is the open of the next candle. Okay? Because when this candle closes above the trend line, that becomes the open of this candle. So the open here, 82.29. 82.29. All right. This swing low right here. Is 81.78. Okay. I don't trade the dollar. Anybody in here a dollar trader? Per tick? I'm not sure what that is. I'm gonna assume that it would be far more than the equivalent of 8 ticks in the S&P and the ES. Does anybody have any questions on that? I got asked a question about, do I mean a higher close on the hour? The question I think was, Do you mean a higher close on the 4-tick range or some other time frame? Well, it depends upon the time frame that you're working off of. What I like to do, and what I'm trying to convey, I guess, is that I look at the hourly to give me sort of a big picture idea of what my next move should be. And looking at this on Friday, I could tell that a break of this low right here, that was the move I wanted to make Friday afternoon, is I wanted to be short. Okay? And that's what we talked about on the radio show. Because I'm looking at the hourly, prices come up, it has, put in a little double top here. We had a double top here, and then a little double top right here side by side at the weekly zone. The bearish close here. So taking out this low, if we take out that, now here's the thing, I don't know that we're going to take out, when this candle's doing its thing up here, just getting going, I don't know if we're going to take out that low or not. In fact, we might take out this high. And so in a situation like this, I'm happy to be long above the high of this candle up to the zone, or I'm happy to be short below the low of this candle, or this one, in hopes of getting down to this zone. Okay? This is the whole thing I'm talking about when it comes to predicting the future. Crystal balls, reading tea leaves, what's the market going to do, and all the stress and anxiety that comes with that. Because like if you commit yourself to, well, I'm bullish and, I've got to be long, or whatever the case might be, that's a tough, it's tough, right? So why do that? Why do that to yourself? Why not keep an open mind? If the market starts to move higher, you can trade with the market higher. If the market starts to decline, you can trade with it during the decline. Back to the beginning of the conversation, I said, all I'm interested in doing is finding out what the market has on its mind. Okay? What's the market doing? Not really that's not a good choice of words. What does it have on its mind? What is it doing? Okay? And whatever it's doing, that's what I want to do. And so if price closes above this high, the high of this candle, that tells me the market is trying to get up to this zone. Or forget there's even zones there. It's trying to get up to this high because this is the next obvious area of resistance in the market. If it breaks the low here, or up here, then it's headed to the zone below, or forget the zones exist, it's headed to the next area of visible support, which is here. And if it can take that out, which it did, now it's got to deal with this area of support. Okay? So, look at where we sit right now. If price takes out this low, what do we do? Well, we're going to look left. Right there. See this swing low is 1680.50. I want to be a couple ticks above that. 1681 at least. $16.81. All that is a continuation of that line right there. $16.81. If I get short and my target's 81, that gets me out before we hit this low. That's the same principle that got us into this trade where we got short at 84 down to 81. That's what the tweet said. It said consider being short below 84 down to 81. And that's what the market did. It overshot it by just a little bit. And so over here, see, the question is do we have is there enough room there to make it worth trading? Sometimes there isn't. The swing low here is 82.50. So, 82 is the minimum I want to consider getting in. 82. That would be this line here. A break of 82. But see, that's only 1 point. From 82 to 81. That's 1 point. Do I really want to put on a trade and risk 8 ticks for a shot at picking up 1 point? No. Is there a way to turn this around and kind of get it to work in your favor? Is there a way to do something with this? Yeah. What you could do, now you've got to be comfortable with the idea that if price does break below 81, that it is going to make a run at this low. Okay, if you're not comfortable enough yet with the law of support and resistance, and I don't have to call it a law, but the facts of support and resistance, if you're not comfortable with that, this might not be a trade for you. But one way that you could trade this would be simply to get triggered at 82. Okay, 82, you're triggered in on a stop. All right. As price gets to 81, you immediately get your stop to break even. At 80.75, you lock in one more tick. So now you're at break even plus a tick. No way you can lose on this trade. You're at break even plus 1 tick to cover your commissions. If price bounces off of this low, comes back, stops you out, it's not a problem. If it manages to do what it's been trying to do for days, see, the last time we got down into that area was on July 30th. Okay. This swing low here at 80 and a quarter couldn't quite get down there. Couldn't quite get down there. Nope. And here we sit. Does everybody understand the premise of that trade? Let's see. Ken, you got a couple questions. Did you say the 4-tick only is recommended to use intraday, not in Globex? No, Jeff, I didn't. I might have said something that sounded like that, but no. The 4-tick range is the 4-tick range chart. I use that on Globex. I use that on Globe. There's no. Let me try to say this so that it makes sense. No, I didn't say that. How about that? The 4-tick range chart works just as well. I mean, it's just a chart. So Globex, day session, either one's fine. Okay, so now Ken's question: you're making your decision on the hourly close above or below certain levels. I do, Ken. Yes. In answer to your question, Ken, yes, I do tend to go to the hourly to make my decision whether I want to get long or short. Okay, and so I'm looking at an hourly here, and I want to get below this low and this low. Okay, and I want to get a couple ticks below that. Right, I want to get a couple ticks below that before I get engaged. I don't want to get. In fact, I don't particularly like, this is really close quarters here. There's another way to do this. Okay, let's go back to this swing low here. 80.5. 80.5. Yeah, that's still, I was going to say, if we, 80.5, if we went to 79, that's still, yeah, not much difference. I thought if we waited for a break of this swing low and then to go to the zone, the other one's better because if the trade goes in your favor, you've got more room to run. Okay, you're able to protect yourself if it's going to reverse on you. But yeah, this is the trade. I'm probably going to tweet this out with some rather lengthy instructions, and then we'll see how it goes. We'll see what happens. Now, let's go back and look real quick at Friday on the 4-tick range. Here's the numbers that we were, this is what we were dealing with, okay? But I think once we look at the 4-tick range, that'll clear it up for you. Okay. So right here on the 4-tick range, we get the bearish cross, okay? At a price of roughly $16.89. Bearish cross. Now, price pulls away right here, but there's just that little flicker, and then you're sucked right up into the green line there. So that's not a trade for me, okay? All right, here's the trade. Bearish cross, price pulls away, price pulls back. Okay. Come over here, look down, got bearish divergence. Price pulls away, price pulls back. But because, let's see, which candle? Actually, this is the candle that pulled back right here. And so, you really don't need a trend line there. Now that I'm looking at this a little closer, bearish cross, price pulls away, price pulls back. This is the candle that touches the BBC. So we got to come straight down. The cycle line's still red. Now it changes to blue on the next candle, but that's not the one you calculated on. You actually calculated on this one. Here's the deal. It's the same thing either way, I believe. And just in this instance, because if we take this across the bottoms, that's our down close. So it's gonna, in this particular trade, is gonna come out the same either way. You're gonna be selling the open of this candle. The open of this candle is 88. The drawdown is 88.75. So there's a 3-tick drawdown in this trade. And then it goes down to a swing low of 82.50. Sell the open of this candle, 88. You have a 3-tick drawdown, and from 88 we go down to 82.50. Where did I get 3 points from? candle opened at 88. $82.50. That's 5.5 points, right? I must have been really tired the other night when I did this. When I marked this up for a video, so it's 5.5 points. That's if you're staying. That's if you're hanging in there, right? That's if you're staying in there, trying to get more out of it, or if you're happy with a couple points. I mean, there's a great art. Don't get me wrong. There's a great argument for if the trade's going to give you 5.5 points, why not take it? Why sell yourself short with 2 if without a fight it gives you, you know? And I don't. And I won't argue that point because I don't have much of an argument for it, except in those instances where, you know, you get into really choppy markets and there is no follow through, and you continually are getting stopped out. So it's a personal thing that you have to work out with yourself. The biggest problem to that is every time this right here happens, because you've been round and round and round and around the mountain, and it's like, oh man, I'm so sick of leaving money on the table, you know. I took 2 and the thing went 5.5. I mean, based on 2 points a day, that's half my week, and it just fell in my lap, you know. If you're going to agonize over money you left on the table, then you probably have to go the other way. But then you're going to go through a series of trades where you had 2 beautiful points on the table, and it came back and you end up getting stopped out at, you know, break even or worse, right? And so you start to do the flip-flop. One day you're convinced this is the way to go, and then the next day you because of whatever unfolds that day, you convince yourself, no, this is the way to go. And then you're just, you know, pulled back and forth, and it'll make you crazy if you let it. So you got to decide what you're going to do, come heck or high water, as they say, and then just stick to it and just do it. Just do that thing. Whatever that thing is you're going to do it. And maybe you come up with a way that's flexible, that allows you have some rather rigid rules based on whatever criteria you establish. You have the liberty to do that. And so, you know, you trail a stop. And so by doing, probably what ends up happening is you do catch some of these runners like this, the S&P. Now, other markets have more of a tendency to run than the S&P. The S&P, you're not as apt to catch the runners there. But you're also able to trade this for $500 intraday margin. So there's a trade-off there. If you're not going to just take 2, if you're going to go with the trail, you're probably going to get stopped out on a lot of trades with just 1 point. And there's nothing wrong with that. But you have to figure out over time the amount of times that you catch the runner. Does that balance it out? Okay. And really, if you think about it, that should be your worst problem right there. Because if that's the thing you're wrestling over, it means you've already overcome the hurdle of just being confident that you can take a couple points out of the market every day. See, that's actually a good problem to have. Don't let it make you crazy, but just accept it. It's a good problem to have because you've overcome the hurdle of the couple points a day. Wow, huge turnout for a Sunday afternoon. I had no idea. Maybe we'll do this more often. All right, let me go to the chat box. I'm going to have to go here pretty quick, guys. If you got any questions, go ahead and type them in. There's a bunch of you, and I think you just want to hear me talk. And I would really rather, if I could, answer questions if you have any. Because I talk I do that all week. Anybody have any questions? Because I think I'm gonna end it there, because I do have work to do. I've got to put the zones together for the week. see what the week's shaping up to look like here. Now remember, these are last week's zones, so don't let those throw you. I haven't started yet. 86 to 89 looks like a pretty good trade, but I'm not going to sign off on that at the moment. Am I? Let me look. 86 to 89. No, I don't think I am. I'll work on it, guys. And you already know my thoughts on this one here on the short side. I'm not crazy about either one of them, quite frankly. Let's see if there's... definitely not going to trade the dollar. Alright, that little tail we left hanging out there on Friday on the soybeans. This is a daily chart of the soybeans. Alright. Okay. That you were kind enough to come out on a Sunday afternoon. Let's put a trade out there that I think's doable. The swing low here is 1180. And let's see. How much does volatility factor into your ideal market to trade? That's a good question. I'm hearing a noise. You're taking smaller scalp trades and now going for the bigger moves. Matt, I'm not. Rephrase that question so that I can answer it for you, okay? 'Cause I'm not sure exactly what you're asking. Kevin, your question: how much does volatility factor into your ideal market to trade? It depends on the market, and it doesn't keep me out of a market. So I guess in answer to your question, it doesn't. I always want to be aware of what the volatility is in a particular market, but it doesn't factor into whether I trade it or not. So, and by volatility, guys, he's talking about, I showed you the ATR, which is the average true range. Okay, so currently the average true range on the daily chart, 24-hour chart of the S&P 500 is 12.8. Oh, I'm sorry, that's the daily. But we can put it on an hour, and we can even see what it is. Like it's 3.79 right now, hourly. You could even drill it down to 5 minutes. You can go to any time frame you want. So on the 5-minute chart, it's about a half a point. The more volatility, the better. I would rather trade a market that has some good volatility to it. That might be a better answer, or a better way of answering your question. I would like on the days back here when in the S&P on the daily, when we had an ATR up around, that's when you kept hearing me say, boy, these are the good old days. I just kept saying that over and over and over, right? Because there was a lot of really nice two-sided action, buying and selling. It was just great. And it's just been a little tougher here. The ranges have been just very congested and very constricted. So let's go back to this soybean trade for a minute, and we'll put together a trade. Let's open it up. Take a good look. Okay. Now the swing low of this candle is 1180. Okay. Those of you that know anything about fibs, and I know that some of you do know quite a bit about fibs. Some of you spent a lot of time studying, as I did. Okay. I spent a couple years dedicating my life, literally, to trying to make Fibonacci a standalone trading methodology. It just does not stand alone. Okay, it's a great analytical tool. It's a great confirmation tool. It's just not a standalone trading methodology. But it took me a couple of years to figure that out, but thank God I finally did, because that put me on a path to putting together a strategy that does work. Okay. All right. So we've established that the swing low of this candle is 1180. Okay. $11.80. All right. So could we just get short below 11.80? We could. There is a good possibility that at the 50% retracement, which is 11.78, we could see some buying support come in. If it gets through there, then there's a good chance that we could see buying support at the 62% retracement, which is 11.74. We've got 11.80, got 11.74, and then we've got this. I want to get below this 11.74. I want to get below that. I want to get below that by, I don't know, call it 11.70. What in the world? 11.70. I think my computer needs a reboot. Okay, now the swing low of this candle is 11.64.75. Call it 11.65. $11.65. That's the swing low of this candle. So if I'm going to get short at 11.70, I want to get out before 11.65. So it doesn't leave a lot of room, does it? 11.74 to 11.70, 65. It's a nickel. Again, this is where you have to ask yourself, is it worth exposing yourself? Is the potential reward on the trade, worth the exposure? I'm not convinced that this one is. See, and it's very easy for a 62% retracement there to get spiked. Okay, where the little wicks come down, just enough to trigger you in. Now, being a nickel below, I like that. That's not a ton of room, but now you could just toss this out, right? You just toss that out and get short at 11.70. You know, 11.75. Trade that down. You got a dime down to 65. And this is a case where you would be very, very tight with your stop. Okay. As soon as you have 2 pennies in your favor, you're going to go immediately to break even, and then break even plus a tick. If you're going to attempt to get everything out of here. Now, if you're just looking for 2 cents, which is the equivalent of 2 points, then this meets the criteria. There's plenty of room for that. Let's go look at it on a 4-tick range. Looks like we got a crude trade setting up right there. Maybe we should look at that. Alright, let's go ZSX3. Okay, we're getting a bearish cross right here. Okay. Look at this gap. Do you see this gap here on beans? This is where we closed Friday. Friday we closed at 11.83. Tonight we opened at 11.87 and a quarter. So we had a 4 penny gap, and then we put in a double top right up here. Okay. I think based on the bigger picture perspective of the hourly, that on a soybean trade, I would just, if you're going to trade the soybeans tonight, get below the low of this candle here, which is going to be 11.80. Okay. Now see, you don't even see 11.80 on this over here, right? 11.80 is way down here. Less your trade is, and that's another way to look at it, if your entry, because we expect 82 to be good support until proven otherwise. I mean, you could trade it down with, in other words, you're making this your actual target on the short trade if you get triggered in time. See, by the time this crosses, pulls down, pulls back, and your divergence, right now you got bullish divergence, that whole thing's got to switch around. But it's conceivable that you would have a slingshot entry if it starts heading in that direction. It's conceivable you could have a slingshot entry down at 11.83, 83.75. Okay. If that were to happen, you could take that with this 80 being your target, or you're just looking to take your 2 pennies out. Maybe the best thing I can suggest to you on soybeans is just don't trade in this area right here. If you're going to get short based on the slingshot, but get out before you get to this area, or as you're getting to this area. You know, you take what you've got, because there's a good chance for it to bounce from here. If it gets through this area, you've got fibs to deal with all the way down. You don't have any clear sailing until 11.70. But you do have about 4 pennies of clear sailing from 11.70 down to 11.66. So maybe you just jot those numbers down. If there's a slingshot opportunity on the soybeans to get short below the current price and still have a couple points room to run before 81, that's a good trade, potentially. And to be short from 1170 down to 1166. If the slingshot gives you an entry, and at your entry point on the slingshot you have 2 points room to run, that could be a good trade. Now that's just now all we've done is just, we've just picked the short side of this thing apart. Is there nothing on the other side? Well, let's go look. The reason I am thinking about the short side of this, and we're on a big time frame, we're on a daily, but look where we are on the chart. We've had a bearish cross, so it's only natural that we would be thinking about a short trade. Now let's drop this down from a daily to an hourly. So let me check. On the 9th, we closed at 1183. We opened at 1187 tonight. Okay. Alright, so let's do this. Because this could turn back up right here. Now, on an hourly, well, let me not get into that because that's just going to get confusing. Let's look at some reverse fibs, see what kind of obstacles we have. Not much. See, well, from here, once you hit to 90, you've got to 94. But you got this little wick sticking up here to 92. So I don't particularly like that. You could get triggered in here at 90, then you're running into trouble at 92. Could you get a couple points there? Yeah. And if you're aggressive with your stop, could you just keep moving it? Yeah. No. Honestly, nothing. Just see. Sometimes I look at a market, I look at a chart, and it just, a trade just jumps out at me. Just goes, oh wow. I go, meh. So when I start having to study it this hard, man, maybe it's not the market. Let's look at crude. Our last tweet on crude was from 105 to 105.45. It's 45 cents. Now we're on a daily chart. So when you can find something really good on a daily, and then you can drill down to the hourly and it looks good, and then when your 4-tick range gives you an entry, it's like you have this incredible wind at your back. Okay, so now these are reverse fibs. That doesn't mean anything to a lot of you, some of it does. Fibs are typically drawn from a swing low to a swing high, but you can, same math, from swing high to the swing low. So once we break out above this 62% retracement here, you've got that as potential resistance and that. Now, because we're on a daily chart, let's think about how far that is. Okay. Swing high on this one is 107.27. 107.6. So see, from 27 to 69, there's about 40 cents in there. Okay, from this wick to that wick, there's about 40 cents in there. Now from this wick, the top of this wick, on the daily chart, 107.70 we'll call it. There's $1. Okay, this move. You know what? I need to fix my. Let me fix this chart real quick. Okay. All right. This little spot right up here. Okay. Now, reverse fibs. This is the swing high. This is the swing low. Price has already pulled back to the 62% retracement. On Friday, it almost touched it. It came within like a tick of touching it. But let's say we gather some buying support and we start to rally this thing. Okay, we got to get through that 62% retracement. That's an obstacle to the trade. This little swing high, that's an obstacle. This little swing high, that's an obstacle. But once we take out this swing high, there is nothing in the way of this. Except, okay, and this is a big except, people who shorted this on the way down, they had a very nice profitable ride. As price comes back up into this area, there's people who may want to jump on that thing early and run it back down again. Okay? But with the benefit of the 4-tick range, you know what it looks like when that's happening. Okay? Let me show you. Right there. Oh, wrong chart. There we go. Right there. Or right there. The trade that we had on Friday in the crude, all it was, okay, all it was from the top of this wick, I got a little bit above that wick, and then I got us out right before we hit that fib. That was the trade, 105 to 105.45. It was that little bit. See, if you look left, right, there's nothing there. There's no resistance to the trade from here to here. And it just kind of glided through there. Okay. Now, in a smaller time frame, of course, there was some back and forth and all of that kind of stuff. But looking at it here from the daily, okay. Now, I'm going to go ahead and I'm going to write these numbers down on crude. Crude 107.80. If we go to 108.30, that's 50 cents. Okay. So, if we were to get long from 107.80 up to 108.30, that's a 50-cent move. And the only reason I'm anxious to get out early is because of sellers coming in early to push it down again. See how they pushed it down, ran it back up, kind of a double top here, pushed it down. They pushed it a little further down. We have a lower low this time. So the chance of them coming in early, they came in a little early here, see? If you look at that high and this high, came in a little early. They might come in a little early again. It could come in a lot earlier. You never know. The concept is just to find a spot in the chart where there's not an obvious obstacle to the trade. And so that's what I like here. That's what I'm interested in. So I'm going to keep that in mind. Crude long 107.80. All right, now let's see about the short side. There's a potential for support, this 104.70, and then there's this wick here is at 104.90. This little box in reverse I kind of like. See, there's a short trade setting up on crude right now, is there not? On the 4-tick range? There is. And you got bearish divergence. It didn't change colors. There's the bearish cross, the pull away, the pull back. This thing's already triggered, guys. So I'm not a... We didn't need a trend line either. So the entry on this trade would have been 105.80. Here was your down close. So the open of this candle was 105.80. And what price are we at now? 105.79. So you're only a penny off the entry. If we'd have been on top of it. So I'm going to leave you with that for now. I'm seriously, I got to get to work. I had not intended to hang out this long. I'm glad I did. I had a good time. So I hope it was helpful for you guys. But let's look. You got an ES trade setting up too. You do need a you do have to have a trend line here. So you want to be below this trend line on the close. Yep, I definitely need to reboot my computer. It's been, I think, 2 weeks since I rebooted it. And my machine runs 24/7. Yeah, I'm having a hard, but you can see the trend line. I'm not gonna. All right, think about this trade. All right, now here's the setup on the 4-tick range. The entry was, and we didn't take it, but the entry would have been, if we'd have been watching it, 105.80 to the tick. 105.80 was the open of this candle. This was our down close. The open of this candle, 105.80. Now, what I really want you to see, if we come over here to the daily, if we were to get in the trade, if we had gotten in the trade at 105.80, where's our resistance or our obstacle to this trade? Well, the top of this box that we put in the other day is 105.45, but look at 105.29. Okay, that's the 24% retracement. I've never been a fan of the 24% retracement. That's probably because the person that taught me about fibs said it wasn't important, so I probably just bought that, you know, because when When somebody, who's tall and sounds very confident and has a swagger when he walks, says something, you just tend to believe it, right? That's why I'm always challenging you guys when you tell me, when you make statements to me, whether it's on the phone or an email, I always ask you, well, why? Why do you believe that? I always want to challenge your beliefs, not because I'm trying to be a jerk. I want you to know if you're standing on solid ground. Maybe you're just parroting, what you heard because it sounded like whoever said it really knew what they're talking about. And this isn't just in trading, guys. When you're in church, okay, some guy may get up there and he's very charismatic and he may say some stuff, and you get all caught up, very emotional. Everybody's going, yay! And you walk out of there believing something that there's no biblical foundation to it at all. It just really sounded awesome. And maybe he wound it around so that it kind of sounded like there was some, foundation to it, when in fact there wasn't. So, I always question I always question my beliefs. I encourage you to do the same. Every time you go, I believe so and so, ask yourself, why? Why do I believe that? See if you have an answer. You might have an excellent answer. Oh, I know exactly why I believe this. Boom, boom, boom. I lived through it. I did it. Whatever. Or you might go, wow, I don't know. I'm not sure why I believe that. Maybe it's worth doing a little self-discovery. Not saying whatever you believe is wrong, but how much more powerful will that belief be if you come to a place where you understand why you believe it? Then it becomes very powerful. So, back over here, if you were to get short or had gotten short, well, you can get short now at 105.81, which is a penny better price than the initial entry that we were offered based on the setup. The setup gave a price of 105.80. You could sell it now at 105.81. On the way down, what do we got? 105.29. 105.29. We'll call that, call that 105.40. That's a 40-cent move. That's not a bad looking trade. It's not a bad looking trade. Let's look at it on the hourly. GCLU. A little different story over here on the hourly, eh? I say that sometimes for our Canadian friends. I go, eh? Okay. All right. Where would we expect price to, let's say we're just looking at the hourly. Hey, man, we got us a bullish cross, price pulled away. Now all we need is price to pull back. Okay. Look where price is. 105.24. I mean, look where the BBC is. 105.24. Now, this is an hourly chart. There's a bullish scenario in front of us. And if we were of a mind to get long the hourly chart using the slingshot, right now we would want price to pull back to 105.24 to give us a long trade. Right? Okay. Remember that number. 105.24. 105.24. Okay. There's 105. Come on. You get the idea. This little line right here is 105.29. See it right there? For some reason it just doesn't want to do 24. That is infuriating. Alright. Get my point? Does everybody see that? We looked at a daily chart of the crude, we saw an opportunity for a short trade. The 4-tick range gave us a short entry. The hourly is painting a picture of a long trade. But for the long trade to come together, price has to pull back to 105.24. So even though we've got a drawdown going on right now with the 4-tick range, see there's a 4-tick drawdown right now. Remember we said the to the tick entry was 105.80. If you had entered on the down close, right now you'd have a 4-tick drawdown on your hands. Okay? Did everybody follow me on that? Let me run through these questions really quick. Yeah, Rich. Right now, there's an issue with the Daniels Trading site. It'll be back up and running, hopefully here pretty soon, and you'll be able to download your platform then. Okay, there's still an opportunity for anybody that's interested in this crude trade. Okay. You may not want to be in this crude trade, but you know what it looks like on the daily. You know what it looks like on the hourly. You know what it looks like on the 4-tick range. Okay. Now, given all this information that you have right now, remember that on the hourly, to give you a long trade on the hourly using just the slingshot setup would come down to 105.24. There's 105.29. That's the 24% retracement. So for 30, that's about a 50-cent move. That's $500 from where we sit now to this line. That's a 50-cent move. Does anybody have any questions on that? Okay, G, oh G, you got here, boy, we're just taking off. We've been in here now for a lot longer than I had planned. Well, hour and 24 minutes to be exact. G, what's your question? Well, yeah, G, what we were looking at was a potential short trade on the crude, okay? From where we sit at 105.83 right now, down to this 24% retracement at 105.29, and part of the reason there was On the hourly, we actually have a long setup, but part of the criteria for the long setup is that price would pull back to this green line right here, the BBC. So we would be fading the setup on the hourly. That's the talk. We would be fading the hourly setup using the daily and the 4-tick range. Now 105.24, now see, that's way down here. Okay, 105.29. If I were trading it, I'd be out way ahead of that. So between there, right, there's a lot of moving around going on. So we're back down to 105.81. Okay, Jerry, great question. Where would you put the stop loss? The entry was 105.80. So you tell me, Jerry, where would the stop loss be? Perfect. Good job. We never risk more than 8 ticks on the slingshot. So we can do all this fancy footwork with the hourly and with the daily. This gives us really a beautiful outlook, picture of the market, all that good stuff, right? But then when it comes down to putting on the trade, if we use this, we only have to risk 8 ticks. Could we get, a false start, prematurely stopped out? Yeah. But we have, remember, from 105.80 down to 105.80, if we just use this, because this is the higher number, 105.29, let's call it 105.30. Okay, 105.30, that's 50 cents. So let's say you get stopped out once for 8 ticks. All right, if the thing still looks right, okay, you still got 42 cents to play with. You could actually get stopped out again, and now you've still got 34 cents to play with. You follow me on that, Jerry? Because here to here represents 50 cents. Since you're only risking 8 ticks, if that fits your personality and your trading style, you could actually get stopped out a time or two on the way down, still end up with a profitable trade. So I recorded this tonight, guys, so if anybody ever wants to go back and watch it again once I get it uploaded, I'm so far behind, I apologize, but between the podcast and the video cast, because it takes so long to render them and do the deal and then get them uploaded and labeled, it's only been here in the last couple months that for years I never got behind on this stuff. I always stayed caught up, but we've just been really busy, and that's good. I'm not complaining. I just got to work harder, I guess. Got to find a couple more hours in the day. So I got to run, guys. Not only do I have work to do, my normal Sunday night weekly trading zone stuff and all of that, the email for the partners, but it smells like my wife's cooking a very nice dinner. So I got to go appear to be hungry and eat. Just finished a venti cappuccino wet, so I'm really not hungry. But yeah, life's rough, right? I know. All right, guys, I really do got to run. Listen, I'm glad you guys came out. It's a Sunday afternoon, and I didn't know who would show and how many would show, but we had quite a turnout. I'm really quite impressed at the number of people. So that tells me that there's an interest for this type of extracurricular training. So maybe we'll be able to address that in the future. Okay, where's price? Okay, one last thing. What are obstacles to this trade? Well, got to get a close below the CFMA1 before it can go any further. Then you got to get below this swing low, okay, before it can go any further. The next obstacle to this trade is down at 105.61. So there's about 20 cents room to run before we hit an obstacle. It's a very nice setup. Did you see how we found it? You know, it's like we went hunting. We were just looking. We looked at some soybeans. I couldn't find anything I really liked there. This had some appeal to it. So how's it going to turn out? Well, we'll all know in an hour or two, or certainly by tomorrow morning. Okay? All right. Again, guys, thanks very much. I'll leave these charts running, but I'm going to have to shut everything down here in just a few minutes. So, yeah, I'm just going to go ahead and shut everything down. I'm so glad you turned out. Thanks for coming. Talk to you soon.